Okay, hi there, it's Jeff here with an update on the UK economy. Our focus this time is economic growth, and one of the big topics at the moment is whether the UK can escape a slow growth era. Here's a couple of questions for you. Which of these countries has a higher per capita GDP than the UK, according to the latest data and adjusted for purchasing power parity? Which of them? Singapore, Ireland, Australia or South Korea? Or maybe press the pause button for a second and have a go. Which of these countries has a higher per capita GDP, PPP adjusted, than the UK? Well, the answer is going to be up on your screen. The answer is three of them. Singapore, Ireland and Australia all have significantly higher per capita GDPs. But don't worry, South Korea will soon overtake the UK. It's pretty close. And here's bubble quiz question number 2. Which of these had faster growth than the UK in 2024? Our 4 areas, well, Euro area, Turkey, Germany and Japan. Of course, Germany is a member of the Euro area. Which of these had faster growth than the UK in 2024? And the answer is coming up on your screen. The answer is, again, 3 of them. The Euro area, faster growth on average, Turkey and Japan. Germany actually was a laggard. Germany had slower growth, and we'll come back to that in a second. Here's a quote from Chancellor Rachel Reeves. "There's no substitute for growth. It's the only way to create more jobs, put more money in people's pockets, which is why it's at the heart of our plan for change." So it's clearly the case that as the Labour Party tries to adjust from a rocky few weeks and months, that they're trying to put economic growth firmly on the agenda. And you can see why. This chart shows an index of real GDP for the UK on a monthly basis, and obviously the shock of the pandemic and the 2 lockdowns. But really in the last 2 or 3 years, growth has flatlined. It's barely improved at all. Indeed, this is the latest projection from the IMF. The green lines are the projected growth for the next sort of 4 or 5 years, less than 2%. Indeed, the Office of Budgetary Responsibility estimates now that UK trend growth of GDP is 1.6% per year. And that simply is not enough, as we'll discuss in this video. And here's that international comparison I mentioned a few seconds ago. Growth over the last 5 years from the OECD, published on the 15th of January by the UK Parliament Research Organisation. The United States has seen an 11.5% growth, comparing the third quarter of 2024 with the fourth quarter of 2019, just before the pandemic really kicked in. Canada 7.3%. The two may well be locked in a trade war soon. Italy ahead of the Eurozone, France, a pretty Eurozone average, UK just behind Japan, and Germany has seen barely any growth at all over the last 5 years as a whole. So why is the UK economy growing so slowly? This is a question you might want to think about if you're watching this in class. Pause the video and have a discussion. I think it's important to make a distinction between short-term dynamics and medium or longer-term factors. And these often intersect and interact with each other to cause the problems we're seeing. So in the short term, we've only seen thus far, shallow, limited cuts in monetary policy interest rates in the UK, set by the Bank of England, despite disinflation. We'll come back to that in a second with the chart. We are still experiencing the continued fallout from the cost of living crisis, which is not over, hitting people's real incomes, and the impact of fiscal policy, in particular the increases in tax and the freezing of tax allowances on people's disposable incomes, and also their sentiment, their animal spirits, their confidence. So here's the inflation rate for the UK in blue, and as you can see, obviously there's been a period of quite severe disinflation after the big rise in inflation in 2021-22. Interest rates went up to address that inflation issue. But as you can see, they've only really started to come down fairly narrowly in recent times, from 5.25% to 4.75%. So there are some people arguing that the Bank of England is behind the curve on this, that the bank should have acted a little bit more proactively and aggressively in cutting interest rates down towards, for example, 4%. And it may well be the case that they'll move in February, actually next week at the time of this video, but we wait to see when they move next. Real incomes have taken a little bit of a battering. This blue line actually shows the growth of nominal pay, the annual growth of total pay, which includes bonuses. But if we take off inflation, that's what you get to see. So that's the growth of real pay in grey there. And you can see real incomes took a big hit into 2022 and 2023. So a much flatter trajectory. And have a look at this chart. This chart shows real disposable income per household in the UK since 1977. Okay, and there are times of recession, the early 1990s, for example. And then obviously real incomes fell sharply after the global financial crisis from 2008 onwards. But take a look there. In 2008, real disposable income per household was £42,000. The latest figure for 2023, it's 40,916. So real incomes are lower than they were 10, 15 years ago. Median income, of course, is much lower. The mean is much higher than the mean because of the impact of the skew caused by people on very high incomes. So real disposable incomes have been flat or stagnant or falling for many people. Rachel from accounts, the Chancellor of the Exchequer is clearly under pressure, and I think she's hit a nerve with businesses. There was quite a poor business response, it has to be said, to the October 2024 budget. Here's a headline there from the Guardian. Government under pressure on economies. British households anticipate worsening finances. And something from the BBC, Simon Jack there. Costs just keep rising. The jump in firms in trouble. There's been quite a significant increase in the number of firms reporting financial distress, which could be a forerunner of problems to come. And business confidence is declining. Now, this is an index of business confidence, 100 on the y-axis there represents the long-term average. And you can see there has been quite a sharp fall in business confidence in the last few readings. Is that an indicator, a lead indicator of a recession as we head into the first half of 2025? Taxes have gone up. The overall burden of taxation, that's where we add together all the money that comes in from direct taxes, such as income tax and national insurance, and from VAT, indirect taxes and duties and so on and so forth. The tax burden is now at a 70-year high, and that's both corporate as well as personal taxation. And that rise in tax is not to be underestimated. Fiscal drag in particular is taking tens of billions of pounds of income from people, affecting their spending power. And one of the problems the government's facing at the moment is the cost of servicing their debt is going up. This chart shows the average monthly yield from government bonds. Essentially, it's the interest rate the government pays when they have to borrow money. And again, look at the far right-hand side there. The yield on 20 and 10-year debt is now, close, touching towards 5%. It's higher than it was in 2022 during the Truss quasi-Kwarteng brief, the famous emergency budget and their brief leadership. So some short-term dynamics, interest rates not falling very quickly, real incomes were not rising very much, disposable incomes being cut by higher taxes, confidence fragile amongst both consumers and businesses. And then we have some medium-term dynamics. Now this is where you really focus on the supply side of the economy. Growth in the UK is constrained, it's limited, it's hemmed back by chronic infrastructure gaps, which we see in our daily lives, the result of decades of underinvestment in energy, in water, in housing, in public services. There are labour market weaknesses we'll touch on, in particular persistent skill shortages and economic inactivity. I'll mention too the impact of an ageing population, something not to dismiss. I've read some recent papers looking at that. And the elephant in the room, sorry to bring it into the discussion, but we are starting to see the impact of Brexit-related trade disruptions. It's a lot of small businesses in particular saying they're facing increasing costs of doing business across borders and the fall in trade intensity, particularly amongst, as I say, smaller businesses. Economic inactivity has risen, and in particular, as you can see from this chart, there's been a big rise in people who are inactive due to long-term sickness. Inactivity, people of working age who are not active in the labour market. They don't have a job, and neither are they actively looking for work. And you can see there has been a huge rise, the best part of 750,000 increase in economic inactivity due to long-term sickness. The lagged effects of long COVID really starting to show through there. The ageing population, again, is something not to dismiss. This chart shows the median age of the population of the UK in 2023. It won't have changed fundamentally in the last year or so. And whilst there's obviously a big gap between London and the rest of the population, that median age continues to rise. The southwest has the highest median age. And there's the population of the UK in the same year by age group. And you can see the sort of numbers of people, estimated mid-year populations by group. But have a look at this chart. This chart shows the elderly UK population from 2020 through to 2050. I've put on the right-hand side a little reminder to myself that I will appear as a purple item by the time we get to 2053, if we all get there. But clearly this is going to have an effect on the UK. That as of 2020, there were about 16.5 million people aged above 60. By the time we get to 2050, that figure will be nudging 23 million. The dependency ratio is going up. How are we going to pay for and sustain and finance social care for the elderly, the demands placed on the health service, and much else besides? So why does a slow growth matter? I've said that the trend growth of the UK is probably less than 2%. Well, it is. So why does it matter? Let me give you three reasons. First of all, weak growth holds back tax revenues. The government needs growth of the economy to generate more money coming in from indirect and direct taxes. So it just makes it harder for the government to finance the growing demand for public services. It also makes it harder to control government debt as a share of GDP, because the debt stays high, and if GDP, the denominator, is not rising fast enough, it's very hard to bring down debt as a share of national income, which the government wants to do. And there's the chart showing national debt as a share of GDP now tracking at around 100% of our national output. Secondly, anemic growth, anemic means weak, contributes to persistent relative poverty. It's much harder to fund the welfare system if you don't have the money coming in. And therefore, over time, we see more families falling into fuel poverty, into data poverty and other forms of relative low income. And that has long-term economic and social consequences. The number of people in relatively low income is shown in this chart. Before housing costs, the latest figures we have, something like 11.5 million people living in households below 60% of the median. If we add in housing costs, of course we know things like rent is hugely important there. Something like, well, over 14 million people are in relative low income in the UK. And here's a chart just showing the scale of welfare recipients. Now, clearly, this chart shows the percentages of households receiving benefits in 2022. 53% for the UK. A large slice of that are, state people receiving the state pension or families receiving child benefit, for example. But means-tested benefits to people falling below the poverty line also have an impact. So in Wales, 60% of the population receives one or more benefits. In London, the figure is 40%. And there's the chart showing the increasing scale of benefit payments by the UK government, now over £250 billion per year. What's the point of showing this chart? We need growth to help fund this. It's probably not sustainable unless the UK economy can achieve a faster rate of growth. And the third reason, I think, is the wider consequences of a slow-growing economy. I would argue that persistently weak growth and falling relative living standards, keep in mind countries like South Korea may well overtake us. They've already overtaken Japan, for example. That can make the UK a less attractive place for inward investment because financial capital and real investment seeks the highest returns. So a slow-growing economy does, I think, act as a potential barrier to inward investment, other things being the same. So let's think more positively. What would you do to kickstart economic growth in the UK? If you're watching this video as part of a lesson, again, this is a moment to press that pause button and have a discussion. Well, pick out 3 or 4 policies that you think would be a strategy for growth in the UK. That quote again from our Chancellor: "No substitute for growth. It's the only way to create more jobs, put more money in people's pockets," which is why it's at the heart of our plan for change. Well, Rachel from Accounts, as I call the Chancellor, does have a plan. A really important recent speech pictured there has been picked out 7 or 8 aspects of the plan. First of all, housing reform. The government is desperate to try to encourage and achieve more new houses. Reforms include planning changes, including a zoning scheme where development near train stations would have a presumption in favour of the housing being given permission. She was quite strongly hinting that the government would be supportive if a new scheme for Heathrow's third runway was to come forward. And Reeve subsequently said that she thought a third runway could be built and open within 10 years. There's extra funding for fast east-west rail to run between Oxford and Cambridge. 9 new reservoirs are planned, mostly in the south. The UK simply hasn't built many new reservoirs in the last, 30, 40 years. Interestingly, that plan for the regeneration of Old Trafford in Manchester, the government wouldn't fund the new stadium, but would be supportive of funding housing and community facilities. Reeves is suggesting there might be an easing of mortgage lending criteria to make it easier to buy property, and she's desperate to engineer a plan to unlock tens of billions of pounds from corporate pension schemes, illiquid wealth, to help fund infrastructure. I'm really interested in Matt Clifford's report. Matt Clifford, founder of Entrepreneurship First, has written a really, really good, superb paper on AI opportunities. You can download it from the government there. And the government is committed to, I think, most of the recommendations in Matt Clifford's recent report on AI as a growth catalyst. I said that the government wants to build lots and lots of new homes. Well, the target is quite ambitious. They want 1.5 million new homes over the next 5 years. Now, I've done the maths for you. If you divide 1.5 million by 5, you get 300,000 new homes per year. You can check the maths later if you want. So then I went back to, how many houses were built in the UK all the way back to 1949, and who built them? And you can see private enterprise, housing associations, local authorities. Well, the last time 300,000 homes were built in the UK was 1977, so the best part of 50 years ago. And for most of those subsequent years, we haven't even come close. Occasionally we build 200,000 homes. Now, the idea that suddenly we can get to 300,000 new homes every year, if we could, it would clearly drive growth in construction and related industries. But who's going to build the new homes? Who are the plasterers? Who are the bricklayers? Who are the structural engineers? Where's the labour going to come from? And the materials and the machinery and the energy to build these new homes. That is a very ambitious target. I wish the government well. If they achieve it, they will certainly achieve a faster rate of growth. But no mention of the B word. So, as you know, those of you who follow my channel, I am a very strong supporter of the European Union. I think Brexit was a mistake. Okay, the government is starting to think about a rapprochement, a rewriting or renegotiation, if you like, a recalibration of our trade relationship with the European Union. Just recently, here was an article from The Guardian. What is the pan-European customs area that the UK is open? The EU is open for the UK joining. So there might be some moves towards the UK entering a customs union style arrangement with the European Union in the next few years. And of course, another big issue is labour mobility. So here's a headline again, I think, from The Guardian. UK EU Youth Mobility Scheme key to better relations, says top diplomat. Can the UK achieve a meaningful, substantive agreement to improve youth mobility, and in particular the rights of young people, which have been taken away from the ages of 18 to 40 to travel and study and work freely in each other's countries? That is, I think, fundamental to the rights of young people, and I wish it would be restored. Rachel Reeves was quoted as saying, before the election, Britain will stay outside the EU. There will be no return to the single market, no return to the customs union, no return to freedom of movement. A mantra obviously made for political reasons, not really for economic reasons. And here's a chart from, I think, a report from the National Institute showing the forecasted impact of Brexit on GDP. As we head into the next decade, the cumulative effect on GDP in the UK from trade barriers, particularly non-tariff barriers, will mount, such that by 2035, 10 years from now, the UK economy will be nearly 6% smaller than it might have been, a counterfactual, had we stayed with our existing trade relationships. We'll add another 6% to an economy with a $2.6 trillion economy. That is a lot of money. So what are we saying here? The UK is in a slow growth phase at the moment. It's hard to see the UK breaking out of it in the near term. Too many things, too many factors holding growth down. Reeves's plan is interesting. There's some positive aspects to it. But even she has admitted that most of these policies would take many years to have any meaningful impact. I suppose the key really is to fast forward planning reform so we can get to start building some houses. And or the UK achieving an improved trade deal with our biggest trade partner, the European Union. So what do we think? Post your answers in the comments. Thanks for joining in. Stay happy, stay positive, stay curious, and see you sometime soon.